Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have USD JPY's 4-hour chart. All charts to be presented are to be of the same time frame. And we have to note that yesterday there was a rather easygoing market. We had no wide volatility. There was one exception, though, which was very notable, and that was exactly USD JPY. We see how the pair was able to continue its upward trajectory, actually verifying the bullish outlook. Sorry. And the pair rose higher, breaking the 150.80 resistance line. Now we have to turn that into a support line. And we're going to be setting the new ultimate resistance line, R3 at 155.5. Right. Okay, let's correct the contents of the labels as well. Starting with the S3 being set now at 148.60. The S2 at 149.78. The S1 at 150.80. The R1 at 151.95. The R2 at 153.80. And the R3 at 155.50. Let's lock everything in. And let's have a small chat about the pair on technical level. Definitely the bullish outlook is still there. We note that there is a steepening of the upward trend line, which tends to support the upward trajectory of the price action. It's going to be put to the test right now. On the flip side, I have some worries which may force the pair to correct lower, and those worries are namely two. The first is the fact that the RSI indicator below our chart, you can see how it remains clearly and substantially above the reading of 70, implying a strong bullish sentiment on the one hand, but on the flip side, may also imply that the pair is at overbought levels and may be ripe for a correction lower. At the same time, we note that the price action is flirting with the upper Bollinger Band. You can see it right here. And that may be slowing down the bulls, may even force the pair to correct a little bit lower. For the time being, we tend to maintain our bullish outlook, yet at the same time, I would be issuing a warning for a possible correction lower, as we have mentioned, due to the RSI and the Bollinger Bands. Such a correction probably would be shifting the steepening of the upward trend line a little bit to the right. Yet the bullish outlook probably will be remaining. On the fundamental level, USD JPY has been an outlier despite some slight, very slight bullish movement of the US dollar. In general, the pair's rise was probably mainly due to the weakening of JPY. And that has been ongoing since the release of BOJ's interest rate decision yesterday morning. I would be noting here that the bank hiked rates, however, failed to provide support for the JPY. And it was the first hike in 7 years, 8 years. No, actually, that was more. It was in 17 years almost. So that was a major movement. It was a historic interest rate decision. Yet, it seems to be the case as if BOJ may have escaped negative rates, but has difficulty to actually continue normalizing, i.e., hiking further its interest rates. And this lack of prospect, I think, would be the main factor which caused JPY to weaken since the release of the decision. We have, on the one hand, easing inflationary pressures, yet those will be put to the test once again on Friday's Asian session. So that tends to more or less advise BOJ to be cautious regarding its next steps. We have to note here that also we have a lack of economic momentum in the Japanese economy, which also is screaming at the bank to keep rates low and actually not proceed with any more rate hikes. So I would be noting, okay, the bank hiked rates by 10 basis points. The bank has escaped or ended its negative rates policy, which was active for more than 7 years, if I'm correct. And yet, on the other hand, seems to be finding some difficulty in actually hiking rates further. And this lack of prospect tends to widen interest rate differentials against the JPY for the time being. So on a monetary policy level, we tend to expect JPY to remain under pressure, under selling pressure. There is a catch here, and it's a big question mark. You have noticed how the pair is nearing the 151.95 resistance line. Now that line is not there by accident. It marks an over 30-year high for the pair. So we could safely say that the pair's price action is so high that it could cause a market intervention by Japan in order to exactly boost the value of the JPY and thus weaken USD JPY lower. It's a big issue, and I wouldn't be surprised to see a market intervention happening in the next 24 hours, especially should USD JPY be able to breach above the R1. Okay, let's have a look at Euro USD. Euro USD, which has suffered a drop into this European session, and that may have been also due to Lagarde's speech earlier on. And at this time, let's have a look. It seems that the ECB president was more balanced, and it was characteristic that she stated, quote, we need to move further along the disinflationary path, unquote. So actually, that tended to more or less highlight the uncertainty regarding the bank's interest rate cutting path. And I would be noting that we may be, if we drill into the 1 hour chart, you can see how the euro had started to fall practically since the early European session today. It's very characteristic. And that highlights also a possible strengthening of the USD. In any case, back to the forward chart. For the time being, we tend to maintain a bias for the sideways motion to be maintained. And on the other hand, though, I would be noting that we have a nice downward trend line highlighting the downward trajectory of the pair. Yet for a bearish outlook, I would require a lower true than this one. You can see how the pair has 1, 2, 3 lower peaks and has 1, 2 lows. So for the bearish outlook to be maintained, the pair has to start aiming for the S1 1.0795. Nothing less. In any other case, any correction higher may put the downward trend line to the test or even cancel it out, and that would be causing us to switch our bearish outlook in favor of a sideways movement bias. The RSI indicator is pretty low. It's near the reading of 30. It's actually 35, which tends to imply that there is a buildup of a bearish sentiment in the market for the pair. You can see how the 50 moving average is pointing downwards, the 20 moving average even more. Note how the 20 moving average has crossed the 50 moving average, implying an acceleration of the downward motion of the pair. It's going to be interesting to see. It's a make or break position practically for the pair. Should Euro USD continue to drop and start aiming, if not breaching, the 1.0795 in the next 24 hours, that could more or less support the idea of a bearish outlook being present here. Yet the main issue for the pair, and I think we have neglected to mention this, would be USD fundamentals. The main event of the day is expected to be Fed's interest rate decision. The bank is expected to remain on hold at 5.25%, in the range between 5.25% and 5.5%. Currently, Fed funds futures imply a probability of 99% for such a scenario to materialize. So practically, the interest rate part of the decision seems as if it's an open and shut case. However, there are other elements which could still shake the markets. And I'm highlighting this. Why? Because the market seems to expect the bank to start cutting rates in June and deliver 3 rate cuts until the end of the year. So more or less, there's still some dovishness expected on behalf of the market in today's interest rate decision. And should that not be expressed in the decision as a wider event, I'm talking now, that could provide substantial support for the USD. Now, if we break down the elements of the decision as such, okay, we've already covered the interest rate part. The second element I would be highlighting would be the accompanying statement with the Fed's forward guidance. Now, should the bank in its forward guidance more or less imply that rates are to remain high for longer, contradicting market expectations, that would be the first element which could provide some support for the USD, and vice versa. Should the bank actually imply that rate cuts are nearing, we may see the USD weakening. The second element would be Fed Chairman Powell's press conference, which is half an hour later than the release and usually tends to go for about 1 hour, 1 hour and a quarter. Now, should the Fed Chairman in his press conference actually push back against any market expectations for a rate cut or rate cuts starting in June, that could once again provide some support for the US dollar. May I remind you that in his testimony before Congress, Fed Chairman Powell, on the one hand, signaled, yes, rate cuts are coming, but at the same time also expressed a relative uncertainty about the path of inflationary pressures within the US economy. And that element was practically verified by the release of the CPI and the PPI rates for February. That was last week. And at the release, it showed that inflationary pressures within the US economy remain rather resilient, which more or less tended to provide support for the US dollar. So, should the Fed chairman actually highlight more the persistence of inflationary pressures and the need for the bank to keep rates at high levels for a longer period, that could provide asymmetric support for the USD. Why? Because it would be practically contradicting market expectations and would force the market to actually reposition itself and adjust the expectations. Now, the third element I would be highlighting would be the new dot plot. The dot plot is a document, a chart, where practically it's depicted where each and every policymaker of the Fed are expecting interest rates to land until the end of the year. The second chart would be until the end of next year. Then we have a third chart about 2 years ahead and a fourth chart for a longer period. Now, we have mentioned that the bank is expected by the market to cut rates 3 times in total. That would bring down the interest rate from 5.25% to 5.5% to 4.5% and 4.75%. Should, though, the new dot plot show that Fed policymakers are expecting interest rates to land higher for the year, it would imply practically that the market has gotten ahead of itself and actually Fed policymakers are planning for less rate cuts. And that would be a hawkish element, thus providing support for the US dollar. While on the flip side, should the new dot plot actually verify the market's expectations for the 3 rate cuts in the year, that could weaken the USD. Now, the decision as we have described it tends to imply that volatility for USD pairs is going to be not only at the time of the release, but it's going to be extended, most probably during the press conference of Fed Chairman Powell. So you should bear in mind that volatility for major pairs would be most probably having a wider duration than just the moment of the release, like BOE's interest rate decision tomorrow. That's one. The second issue I would be highlighting here is that most probably the decision will have ripple effects beyond the FX market. I wouldn't be surprised to see high volatility also for US stock markets, and I would be also highlighting gold. Now, should the Fed in general express more hawkishness than what the market expects, most probably such a decision could weigh on US stock markets. And I'm highlighting this because tighter financial conditions or tight financial conditions for longer could actually curtail the possibilities of companies to increase their revenue and make higher profits. So understandably, a hawkish tone could weigh on US stock markets. Now, as for gold, I would expect a hawkish tone to provide support for the USD and in such way on gold's price. And I'm mentioning this because the US dollar and gold are considered to have a negative correlation as trading instruments. Whenever we see the US dollar weakening, we see gold's price rising. And on the flip side, whenever we see USD rising, we see gold's price dropping. Similarly, also have a look out for US yields. Should the bank actually sound more hawkish, that could increase the yields of US bonds. And given the competitive nature of US bonds and gold as safe haven instruments, a possible rise of US yields would be actually weighing or could weigh on gold's price, given that gold bears no interest. So that's about it about the Fed's interest rate decision today. For the time being, regarding the euro, we tend to maintain euro USD. We tend to maintain a bearish outlook as long as the downward trend line remains intact. And that's supported also by the RSI indicator, which remains quite near the reading of 30, implying the presence of a bearish sentiment in the market for the pair. We would expect the pair to drop. Next test, as we have mentioned, is set at the S1 1.0795. It's a level which provided support multiple times, once, twice, 3, 4, 5, 6 times, but also resistance. So it was tested on both sides of the aisle and could prove to be quite strong. Should the S1 be broken, the next level we note is the 1.07, 95 pips lower, a level which provided support clearly here. Okay, let's have a look at cable. Cable dropped during today's European session, and it's understandable why. We mention here that, let me drill into the 1 minute chart and let me explain what I mean exactly. Now, we had the release of UK CPI rates there for February, and the rates actually slowed down on a year-on-year level, both on a core and headline rate, more than what the market was expecting. They came in lower than expected. And you can see how the pair cable actually jumped up and down at the moment of the release for about 21 pips, rose slightly, yet you saw it coming rolling down. This is the minute chart in the next 1 hour, 1.5. So practically the release of the UK CPI rates tended to weigh on the pound. And given that we have also BOE's interest rate decision, the slowdown of the UK CPI rates tomorrow may allow the bank BOE to actually ease somewhat on its hawkishness. And that could weigh on the pound as well. Once again, I'm highlighting also the Fed's interest rate decision as a key factor behind the pair's direction, but this time affecting the USD side of the pair. So should the bears maintain control, we may see the pair aiming for the 1.2615 support line. It's a level which provides support multiple times, 1, 2, 3, 4, 5, 6. So that's a pretty valid level as well. It used to be the lower boundary of the sideways motion of the pair between the 19th of February until the 5th, 6th of the March, until it broke to the upside. So that's pretty valid as well. Okay, let's have a look now at USD CAD. USD CAD, which showed to be more or less unimpressed by the release of Canada CPI rates yesterday. And I think that USD strength is also depicted in this chart as well, as we have seen in the previous charts also. There is a small catch here. What becomes more obvious is the difficulty of the pair to form higher highs. And that tends to pose some question marks regarding any further ascent of the pair. It seems as if the R1 is holding its ground. Okay, the pair is testing it actively, breaching it for a short period, yet diving just below it once again. If the pair does not actually breach the R1 1.36 clearly, maybe even use it as a support line and start actively aiming for the 1.3695, then we may see the sideways motion prevailing, the upward trend line being broken, and the price action remaining between the R1 and the S1. On a fundamental level, we have already mentioned USD. Given the Fed's interest rate decision is the main detriment here. From the Canadian dollar side, I would be noting the release of BOC's March meeting minutes. And should the minutes show that there is a hawkish predisposition in the bank for the bank's policy, we may see the CAD side of the pair getting some support and actually use the CAD dropping. For the time being, we tend to maintain a bullish outlook. Once again, though, I would like to issue here a warning for possible stabilization of the pair. Okay, let's have a look at AUD-USD. Now the downward motion of the pair is maintained, showcasing the strengthening of the US dollar, yet once again we see how the pair has difficulties forming a lower trough, so that tends to put the bearish prospect of the pair into limbo. The RSI indicator, on the other hand, remains very low. It's at 32.9, which is very close to the reading of 30, implying that there is a bearish sentiment in the market for the pair, which could drive it lower. Should the bears maintain control, we would expect the pair to drop, in my opinion, reach, if not breach, the S1 0.6475. Mind you that the level has proven to be quite valid in the past. You can see how it provided support here, here, and here. Okay, there was a break here, but 1, 2, 3 cannot be neglected. So for the time being, we maintain a bearish outlook. Have some worries though, and we issue a warning about the possible stabilization of the pair, given that the bears of AUD-USD seem to be finding some difficulty pushing the price action even lower. On the fundamental side, I would be noting, besides the Fed's interest rate decision, also Australia's employment data that due out tomorrow during the Asian session. It's going to be a key release. And prognosis right now is for the employment market to be pretty tight, actually to tighten even further, which could provide some support for the AUD side of the pair and allow AUD-USD to rise. To be more specific, the employment change figure of Australia is expected to rise from 500,000 to 40, and the unemployment rate to tick down from 4.1% to 4%. Both elements, if the forecasts are realized, tend to imply a tightening of the Australian market, which actually may allow RBA to maintain a more hawkish view. And that's the element, in my opinion, which tends to provide support for the Aussie. Should the bulls take over, or if you prefer for bullish outlook, I would require the pair to definitely breach the pre-mentioned downward trend line. That would be a first signal that the downward motion has been interrupted. Breach the R1, 0.6535. but I would also require it to breach the arc to 0.6595, nothing less. Anything else could be a stabilization of the pair. Okay, let's have a look at WTI. Let's drill into the daily chart. Let's readjust the labels. Now the price action of oil yesterday forces us to actually raise it a little bit higher. Let's reposition the labels as well. Now on the fundamental level, I would be noting three elements for oil prices. First element would be, in my opinion, the release of AP's weekly crude oil inventories figure. That was yesterday. And the release showed that the US oil market remains rather tight. We had another drawdown, a narrow one of around 1.5 million barrels. But a drawdown is a drawdown is a drawdown. It implied or it showed that more or less demand in the US oil market surpassed production levels. So that was a tendency which was very, very obvious. On the other hand, though, I would be also noting that we have reports that Russian oil exports are increasing. And at an international level, that tends to weigh on oil prices. And the main reason why is because practically that tends to imply that the supply is widening and more oil consumers would be satisfied, thus weighing on the price. The third element, which in my opinion is also rather bearish, would be the relative strengthening of the US dollar. Oil is largely denominated in dollars, and it's understandable that whenever the US dollar rises, importers of oil find it more and more costly to actually import oil. So that could more or less also limit the demand somewhat at an international level. Okay, for the time being, we tend to maintain a bullish outlook, but I would like to see more detail here. And I'm drilling into the 1 hour chart. Let's readjust the upward trend line. Now, the interesting element of this upward trend line, you can see how it has provided support for the price action of WTI over the past 1.5 weeks. 1 week, I would say. Yet that was broken yesterday. And that forces us, along with the fact that the price action has hit a peak at the 83.10 resistance line, that forces us to actually switch our bullish outlook in favor of a sideways movement bias initially. It's going to be interesting to see whether that sideways motion is going to morph into a downward trajectory or not. The RSI indicator is falling, nearing the reading of 50, implying that the bullish sentiment is slowly fading away. And that's another factor which tends to highlight the possibility of a sideways motion. On the other hand, note how the 20 moving average, the 50 moving average, and the 100 moving average are all still pointing upwards. They haven't picked up on the recent downward motion over the past 24 hours. So that may more or less be an idea that the bulls didn't say the last word just yet. In my opinion, for the time being, I'm switching the bullish outlook in favor of a sideways movement bias, with the prospect of a bearish outlook being in place here. Next possible target for the bears, albeit it's pretty low, would be, in my opinion, the 79.05 support line. Albeit some analysts have been mentioning also higher peaks, which could be serving as support lines, given that they used to be a resistance line, now turn to support. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
For waiting, everyone. Let's go ahead and get started. So today's webinar will be on pivot point trading. And before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk. And it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Watching Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. Firstly, we're going to be looking at what exactly are pivot points, followed by what time frames you should use, and then the different types as well, and adding them into your strategy. Okay. So what are pivot points? Okay. So pivot point is it's a pretty popular trading analysis strategy that's commonly used by traders to determine potential levels of support and resistance in the market. So pivot points are basically calculated using the previous day's highs, lows, and the closing. So a series of points are derived from those values. Okay, so just for your information, if you're wondering how exactly can you implement it into your trading strategy, so you would first calculate the pivot point, okay, which is basically the average of the previous day's high, low, and close prices. And this is the most important level because it represents the um, it basically represents the points at which market changes direction, which is why you can then use them as support and resistance levels. Okay. And then the first support level is calculated as 2 times the pivot point minus the previous day's high. And then the first resistance is calculated as 2 times the pivot point minus the previous day's low. And then the second support and resistance levels are calculated by adding and subtracting the difference between the previous day's highs and those to and from the pivot point. Okay. Yeah, but we'll get into that in the next few slides. And normally these points are calculated for you already. So these points, it's important to note that the pivot point trading strategy should be used in combination with other technical analysis tools, because they tend to be predictive instead of lagging, which uses information from the previous day to calculate potential turning points. Okay. Some basic points. So this is what I was talking about how to calculate your pivot points. Okay. But yeah, as I mentioned, these are normally calculated for you. But yeah, so firstly would be to calculate the pivot point. Secondly, calculate the support and resistance levels. And then lastly would be to use the levels as entry and exit points. So if the market is approaching a support level, you can consider buying. And if it's approaching a resistance level, you can consider selling. Okay. Okay. So there are a few types of pivot points. Okay, so firstly, we have the standard pivot point. So this method involves using a simple calculation to determine the pivot point. So that's basically the average of the high, low, and closing prices from the previous trading session. And then the support and resistance levels are then calculated based on the pivot point. Can you get the slides? I don't think that we send out the slides, but this webinar is recorded and I think it will be posted on YouTube, so you can refer to it whenever you want. Yeah, I think the IronFX YouTube is just IronFX on YouTube. Yeah, should be. Yeah, if you're unsure of anything, feel free to just email IronFX. You can get the email on the website. Sure, no worries. Okay, and then our second point is the Woody pivot point. So this method uses a really similar calculation to the standard pivot point that we just talked about. The only difference is that there is a different weighting of the pivot point. Yeah, the pivot point. So like the high, the low, and the closing prices. So the support and resistance levels are calculated based on the pivot point with additional levels of support and resistance added based on the difference between the pivot point and the high, low, and closing prices. Okay. Thirdly, we have the Camarilla pivot point. So for this method, it's based on a pretty complex calculation. Okay, it involves using multiple levels of support and resistance. And the formula for calculating the Camarilla pivot points includes 4 support levels, 4 resistance levels, and the pivot point itself. Okay. Okay, fourth, Fibonacci pivot point. So this method uses Fibonacci retracements to determine the pivot point and support and resistance levels. So the pivot point is calculated by taking the average of the high, low, and closing prices, and then adding or subtracting a Fibonacci retracement level from the pivot point to determine the support and resistance levels. Okay. And lastly, we have the demarc pivot point. So this method uses a series of complex calculations as well, but the calculations basically take into account the relationship between the previous trading sessions, high, low, and closing prices. Okay, but also the current trading session's open price. So the main differences between the various pivot point trading strategies are just the formulas that are used to calculate the pivot points, but also the placement of support and resistance levels. So depending on your personal preferences and the specific characteristics of the market that you're trading, you can then implement these different methods. Okay, so let's look at the pros and cons for each of them. So firstly, we have standard pivot points. The pros of this is that it's pretty easy to use. So it's the most widely used pivot point method. It's also easy to calculate and understand, provides a good overall picture of support and resistance levels. Cons is that it may not work well in volatile markets, and it doesn't take into account the opening price, which may be significant in some markets. It's also less accurate than other methods in certain market conditions. Okay. Next we have the Woody pivot point. So some pros of this is that it's pretty popular with short-term traders. So if you're a scalper, this would be probably a better option. So this uses the current period's opening price and provides more weight to recent price movements. Okay. Cons is that it's less used as it's less effective for long-term trading and it may not work well in markets with low liquidity. Okay, next we have the Camarilla pivot point. So some pros of this is that it's popular amongst day traders and provides more support and resistance levels compared to other methods and can be used to identify potential breakouts. Cons is that it can be difficult to calculate as well as understand, and it might not work well with markets with low liquidity and may require more frequent adjustments compared to other methods. Okay. Next we have the Fibonacci pivot point. So this uses the Fibonacci retracement levels to identify the support and resistance levels. So if you are wondering what is Fibonacci, okay, maybe I will show you guys in a little bit. But it can be effective in trading in trending markets and can be used in conjunction with other Fibonacci tools. Cons is that it may not work well in volatile markets or markets with low liquidity and can be less accurate than other methods in certain market conditions. So it's all really based off of the current market conditions that you're looking at, as well as your own personal trading strategies. Okay, demarc pivot point. Pros is that it's popular amongst institutional traders and can be used to identify potential trend reversals, provides multiple levels of support and resistance, but cons is that it's difficult to calculate and understand and may require more frequent adjustments compared to other methods and may not work well in markets with low liquidity. Okay, so some timeframes that you can consider when you're using this. Firstly, what I want to highlight is that for this time frame in this example, we're on the M15 view and you can see that it's pretty unclear. Like the market structure is unclear. If we're looking at this example, when I change, it's the same chart, okay? If we're looking at the same chart but on a H1 view, we see that the market structure is a lot clearer. So the point that I'm trying to make here is simply that the clearer the swing low and the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. So here I'm talking about Fibonacci retracement, but of course, this applies for pretty much anything, like your pivot points as well, because especially for your Fibonacci pivot points. Okay, but the time frame formula for pivot point strategy for intraday it's H4 and weekly it's monthly. Okay, now let's take a look at some charts. Okay, let me just pull out my charts. Okay. Okay, so let's take a look at maybe pound yen. Okay, just a super random example to show you guys. Okay, so I like to start off by looking at it on the higher time frames first. So I'm gonna look at it from a weekly time frame so that I get an idea of where prices are headed towards. Okay, so on our weekly time frame, we see that prices are in an uptrend. On the daily time frame, we also see them in an uptrend. And on a 4 hour time frame, it's also pretty bullish, except there is a slight reversal over here. Okay, so let's go ahead and analyze this together. So if I'm using pivot points as support and resistance levels, for example, also let me know in the chat if you guys normally use pivot points. Okay, so I'm looking at this on the because my chart I'm using now is the 4 hour time frame. Okay, so I'm gonna change to um mm, okay, so if depending on which time frame you are looking at. So in this case, if I'm looking at the 4 hour time frame, you obviously wouldn't want to be looking at the quarterly time frame because it's a bit covers too much of the time frame. Okay. So you might want to stick with either monthly or even weekly. Okay. But I typically prefer monthly because weekly is a little bit um too recent. Okay. And I also prefer to just look at okay, if you look at here, the settings for pivots, this is the pivot point for standard. Yeah, the standard settings. Okay, so I will look at the pivot, the S1, but I don't typically like to look at the others because it tends to get too um convoluted and I don't like my charts to be too messy. Okay, so I like to just filter it out to just look at the pivot point as well as the first two supports and the first two resistance levels. Okay, so from here, this is actually a really good aid to help you determine where you should place your support and resistance levels. Because you can see here where my R2 is at, this is typically where you would place your R1 anyway. Okay, because your first resistance would be the closest swing high to where price is currently at, which is over here. Okay, so And then followed by, you see this R1 here. If I follow that, I'm at this next swing high, which I would have placed here anyway. So it's basically telling you, basically helps you to support your support and resistance levels. Okay. Oop, no, this is my first support. Okay. Especially in this situation my where this is the highest level, in the sense that I don't have any other reference swing highs where I can place my next second resistance. That's where these levels come in pretty handy. Okay, so we go in with this first, and then I can adjust it later with my Fibonacci levels. Okay, so I'm gonna place my first support there, maybe my second support here. Okay. Okay. So because we typically want to follow the trend, and here we see that it's an uptrend, and on our daily as well as weekly time frames, we've also seen that it's an uptrend. So we'll typically follow the direction of the trend, unless unless we think that price is gonna reverse. Okay. But from the start, we would just go with the trend. Okay. So here now I'm going in with my support and resistance, I mean my Fibonacci levels. And here, the first thing I'm going to do is using a Fibonacci projection. So this tool here that I'm using, this tool, it's called Fibonacci extension. Okay, trend-based Fib extension, but we call it a Fibonacci projection. Let me just hide this so that it's not so messy. And you can see that my Fibonacci projection levels actually match up with my first resistance, first support, and second support. Okay. And in order to use this, we want to look for a flash kind of shape like this. Okay. Next, I'm going to go in with a Fibonacci extension. So for Fib extension, we are looking at the values that are greater than 100. So namely these two. Yeah. But you can look at this as well. Let's see if there's any others. Yeah, but namely those above 100. Okay, and for this, well, the kind of shape that we're looking for is a Nike tick. Okay, so it has to retrace 100% of the head of the tail, of the head of the tick. I mean, of the head of the tick, it has to retrace 100% of it before you can go in with this strategy. Okay, but you're basically looking for a V shape or a tick. Okay, so if we look at this tick here, this Nike tick shape. Mm, okay, maybe I can draw it here instead. No. Okay. Yeah. So for my Nike tick, you can see my 127 lines up with my 100% as well as my first resistance here. So let me highlight it here. Okay, and then my second resistance kind of lines up with my 141. So I'm just gonna adjust it below here. And then we have a 161, which is quite a distance, so I'm gonna just ignore that for now. Okay. Okay. Now let's go in with a retracement. So for Fibonacci retracements, we use these 5 levels. Okay, and then you can see that my 23.6 lines up with my first support, and so does my 50%. Okay, so I'm just going to keep those 2 levels. Okay, so if I put back my pivot points, and change this to monthly like it was earlier, you can see that it has helped me to identify certain resistance as well as my support levels. Okay. You can see my R1 is at my first support. First resistance is there, supported by a whole bunch of Fibonacci values. So this helps you to get more Fibonacci confluence areas, which you would know is pretty significant because it basically areas of Fibonacci confluence, like over here, your first resistance, tends to attract price more. So then you can predict whether prices are going to reverse off of it, are going to test that level, so on and so forth. Okay, let's finish our analysis for this chart and then we can look at another chart. So as I mentioned earlier, we're going to go in for a buy because we tend to follow trends, right? So even though we see it reversing off of our first resistance, let's see, price is moving above the Ichimoku cloud and MACD is also giving us a bullish signal. Okay, so it supports our bullish analysis. Let's look at RSI. Okay, RSI is also giving us a bullish signal. Cool. Okay, it's also giving us a bullish signal. And let's see. Let's look at EMA and SMA. Okay, we can see price moving above both of these values. So it's also giving us a bullish signal. Okay, so pretty bullish over here. Yeah, we might see a reversal back to our first resistance because it does tend to attract price. And when that happens, we can go in for a buy towards our next resistance, which is the second resistance here. Okay. Okay. Next. Any questions? Any charts you guys would like me to go through? Okay, let's go ahead and look at the Aussie dollar. Okay, on our weekly time frame, okay, we see prices being pretty bearish. Okay, with prices moving in this descending trend line. So just to recap, what makes a valid trend line is if there are a minimum of 3 touches on our trend line. But here we have 4. Okay, but yeah, minimum 3. And then on our daily time frame, it is, yeah, we also have a descending trend line. So also pretty bearish here. Okay. Let's look at our 4-hour time frame. Okay, now 4-hour time frame looks pretty bullish. Okay, we see prices moving upwards. Okay, now let's go in with our Fibonacci, or rather our support and resistance levels, because we don't have any trend lines or trend channels. Okay, so here's my first resistance. Actually, because this is pretty close to where price is currently at. So I'm just gonna label it like this. Um, and then maybe over here for my first support. Oop. And here for my first resistance. Okay. Okay, now let's check this our support and resistance levels using our pivot point indicator. Okay, I'm using 4 hours. So my pivot time frame, I'm gonna put it as monthly. Okay, can you guys see how my resistance levels line up with my support and resistance levels? Okay, the only one that doesn't line up you can see is my first support, which is pretty far away from these levels here. But I can see that my support level here shows me that I can pull it back here. Okay, and then I'm in line with another one here. Okay, so you can use the pivot point strategy to support your levels and adjust accordingly. Yeah, but it can get a little bit messy, so you can always, there's always the option of um hiding it in the meantime while you are doing your Fibonacci analysis. Okay, so now that we've done that, I'm gonna go in with our Fibonacci levels, and you can see that. Okay, my 78.6 lines up nicely. Just gonna keep that. And maybe my 100 as well. And let's see. Okay, I'm gonna check for a Fibonacci expansion. So for expansions, we use the negative numbers. So earlier for extensions, for the Nike tick, we were using the values that were greater than 100, and now we're using the values that are less than 0 for expansion. And for expansion, similar to projections, we are looking for this flash shape or like a lightning bolt kind of shape. Okay. So I can see that my minus 27.2 lines up with my first resistance. Okay. I'm gonna ignore the minus 61.8 because it's pretty far away from where price is currently at. Let's see if we have any other levels. Okay, I think I have a retracement over here. For retracement, remember we use these 5 levels. Okay, my 50% lines up, and so does my 38.2. Okay, so you can see the number of levels lining up over here at our first resistance. And I mentioned earlier that confluence areas tend to attract price, so we can likely expect price to continue to rise and be attracted to our first resistance. Okay, but you can see here my intermediate level, this dotted line, intermediate resistance. it does also have a bit of a confluence area because you can see I have three pivot point levels that are lining up with this area. I also have two Fibonacci levels lining up, and in itself, this is a multiple swing high resistance. Okay, it's actually even a overlap. Overlap basically means that there are swing lows as well as swing highs that are testing that area, which means that bulls and bears are respecting the area. Okay. Um, what else? Yeah, so you can see price kind of testing this area here. So you might see a bit of resistance in this area. Yeah, but yeah. So let's take a look at some indicators and see if price will be able to push up from it. The thing is that, okay, so we can see price moving above the Ichimoku cloud. So it's giving us a bullish signal. MACD is also giving us a bullish signal. And if you remember my daily as well as weekly analysis, we briefly saw that it's an uptrend as well. So a lot of upward pressure. So we are expecting prices to continue to push upwards. Okay. Okay, no worries. So, I just got a question. So the difference between the green and the red, green basically means uptrend or like bullish. So bullish basically means you're expecting prices to go upwards, like in an uptrend. And then red means downtrend, you're expecting it to go in downtrend. Resistance we normally use to color red because you're expecting prices to reverse off of it, you know. So that's kind of a downtrend. Support, we are expecting it to bounce off of it, which is why it's green, so uptrend. Okay, and then um, I'm actually not too familiar with robo trading. I am aware of it, but I've never used it on my own. So you might have to do your own research on that. Um, yeah, but MT4 does provide access to automatic trading. Um, and yeah, but if you are looking to reduce loss and maximize profits, I think the most important thing would be to um, work on your like ensure that you have stop loss levels, you know your risk management techniques, which we do cover in some of our webinars. Maybe I'll just go through a little bit here. So in most of my live trading, we use resistance as well as support, like I'm doing now. But basically, you could go in with, I guess in this situation, the intermediate resistance will be your entry, your buy entry, and then your first resistance would probably be your take profit. Okay. Yeah, but I just name it resistance and support so that you guys have an idea of how to recognize these levels. Okay. But yeah, your take profit will probably be here, and we normally recommend you to place it below any confluence areas, any major confluence areas like this, like before any major confluence areas, so that you're able to catch price before it reverses off of them. And then I guess your first support in this case would be your stop loss. Okay. And for stop loss, we would recommend you to place it below any major confluence areas. Okay. So I guess in this case, we'll place it like here, I guess. Okay. So just in case price reverses, um, you won't get stopped out from here. Yeah. But we do go through in depth in a couple of our risk management webinars. But yeah, that's just um, I guess the basics. But the reason why we normally use resistance and support levels is so that you guys can recognize that, this level here is a support level, and then this area here is a resistance because we are placing it at this swing high. Yeah, and we're expecting prices to reverse off of it. Okay. Okay, let's look at, yeah, you're welcome, no worries. Let's look at another chart. Maybe let's take a look at gold. Okay, okay. So same thing, I'm gonna look at it from the higher time frames first, and we see price kind of reversing off of this multiple swing high resistance. Oh, yeah, if you're new to trading, you could actually take a look at the forexarmy.com. Okay, so it looks like this. Okay, let me just drop it in the chat. So, yeah, there are a bunch of free trading guides. So if you want to know how to draw a Fibonacci retracement, so if you're wondering about some of the stuff that I talked about today, you can go ahead and take a look over here. Yeah, it just covers some of the basics as well as some risk and some trade management strategies. Like I mentioned earlier, we want to place the take profit before any major confluence areas and your stop loss beyond it so that you won't get stopped out. Yeah. So it just has a bunch of trading techniques and trade management advice over here. And if you're new to trading, you can take a look. Okay. Yeah, there's also some MT4 guides and tools that you can download for free as well. Yeah, that's just FYI. Okay, let's get back to our charts. So now on a daily time frame, we see prices kind of ranging. Okay, on our 4-hour time frame, we kind of see an uptrend. Okay, so yeah, that's at our support and resistance levels. So yeah, so if you're short on time, actually, you can just pull out your pivot point levels to help you to identify any support and resistance levels, like really quickly. Okay. 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 So you can see here, I have my first support. Mm, okay, here's my first resistance. And this level here is going to be my intermediate level of resistance because price is pretty close to it as of right now. Okay, and you can see at all of these swing highs and swing lows, we have a pivot point or resistance level that has been identified for us already. Okay, so I'm going to get rid of that so that it's not so messy when I go in with my Fibonacci levels. Okay, so 38.2 lines up nicely. Mm, okay. Okay, my 61.8 also lines up nicely. Um, okay, my 78.6 lines up. Okay, I think that's all the levels that we have. Mm, okay, my 61.8 lines up with my intermediate level. And I think that's it. Okay, so we see prices. Let me put back my pivot points so you can see the levels. Okay, and then we're going to go into our indicators again. So price is moving within the cloud, so it doesn't really tell us much as of right now. So if it moves above the cloud, it is a bullish signal, and if it moves under it, it's a bearish signal. So if it's within it, it's not really telling us anything. So I'm going to remove that. And MACD is giving us a bullish signal as well. RSI isn't really telling us anything. Let's see our EMA and SMA. Okay, price is moving above both of these indicators. It also looks like price is currently crossing over each other. So we could be seeing a change in trend. For SMA and EMA, these are lagging indicators. So typically when they cross over, um, it's after the trend has already started. So you can see here, when there was a downtrend, price crossed over only here when the downtrend kind of started like here, but it only started about here. This cross only happened here. So similarly, you can see over here, the uptrend started here, but then we're only seeing the cross happening over here. So just keep that in mind if you use EMA and SMA. Let's take a look at Bollinger Bands. Okay, you can see price moving. It's kind of cutting out of the upper band of the Bollinger Band. Okay, so yeah, also bullish signals. Okay, okay, so we can expect prices to continue to rise towards our intermediate resistance and towards our first resistance as well. Okay, let me know if you guys have any questions. Okay, I think we have time for maybe one more chart, just really quickly. Let's go ahead and look at maybe DXY. Okay, so DXY, we see this steady drop here. You see on our 4-hour time frame, this looks really huge, but on our weekly time frame, it doesn't look very significant. Okay, sure, let's do dollar franc instead then, because we don't have much time. Okay, so on our weekly time frame, dollar francs, that it's generally a downtrend, I think, over here. Okay, on our daily time frame. Okay, on our daily time frame, it does look a little bit of an uptrend. Yeah, downtrend again on our 4-hour time frame. So let's see if we have a trend channel. Okay, no. Okay, let's go in with our support and resistance levels. So I'm going to go in with my pivot points again to help me to identify any significant levels a lot faster. Okay, monthly. Okay, I don't like there being so many levels. Okay. Okay, now let's go in with our support and resistance levels. Okay, we see this level here. Okay, this is our resistance, and then our swing low, maybe over here. Okay, this is our first support. Second support, first resistance, maybe just here. Mm, okay, here. So this is my second resistance. Okay. So same thing. Now we go in with our Fibonacci levels. Okay, we can see 61.8 and 100% line out nicely. Okay, and then okay, we can see this Nike tick here as well. Okay, 127 and 161. Okay, I'm gonna add another level here. Okay, so even though there isn't any pivot point here, I do want to I want to highlight this level because we have a swing low here, a couple of swing highs, and it's also in line with this 127. So when price changes to my first support and then my second support here. So when price um surpasses our 127.2, we can expect it to drop to our second support. Okay. Yeah, I think that's all the levels that we have. Now let's go in with some indicators. So we're expecting prices to continue to drop. Price is moving below the Ichimoku cloud, so it's bearish. MACD is also bearish. SMA and EMA. Okay, prices are moving below both, so also bearish. Let's take a look at Bollinger Bands as well. And you see prices breaking out of the Bollinger Band over here. So it's of the lower band, so it's also bearish. Okay, so the more indicators you can get to line up with your analysis, then is the better. Okay. Okay, I think that's all the time that we have for today. Thank you guys so much for joining me. I hope you guys found this helpful. Yeah, have a great rest of your week, and I will see you guys next week. Bye, everyone. Thanks, guys.